hope you enjoy watching this video. This is Chapter 15 of Accounting 202, Job Order Costing and Analysis. I will be reviewing the highlighted learning objectives. First, we will look at important features of job order production. So this chapter looks at job costing, and Chapter 16 will look at process costing. With job costing, we're looking at producing large, unique, or high-cost items that are built to order rather than mass-produced. And it also means that most of the costs can be directly traced to each job. But in process costing, that is looking at mass production in a continuous flow. So unlike job order production, where every product is different depending on the customer's needs, process operations are designed to mass produce large quantities of identical products. Here are examples of both. So under job order operations, we're looking at custom orders, heterogeneous, low production volume, high product flexibility, and low standardization versus process operations, which we would have repetitive procedures, homogeneous, meaning the same products, high production volume, low product flexibility, and high standardization. Here we're looking at the flow of cost in job order costing. So we talked about this in Chapter 14. So the three manufacturing costs include the materials, overhead, and labor, and those are combined, and then they flow into the work in process. As they're finished, they go into the finished goods inventory, and then finally, if they're sold, they go into cost of goods sold. So again, the manufacturing costs include the raw materials, which would include both direct and indirect materials, work in process, those are the jobs that are partially completed, finished goods are the ones that are fully completed, and cost of goods sold are the ones which are sold. So now we're going to look at something called a job cost sheet, which is useful in job order costing. This is an example of a job cost sheet. You can see at the top we have the customer's information, a job number, the dates, and then we have three major sections: direct materials, direct labor, and overhead. So now we're going to look at materials and labor costs. So these are documents that are useful in keeping track of our costs. So we'll have a receiving report, which includes information on the materials which are purchased, and a materials ledger card. So that's like a subsidiary ledger for materials. So all of these are documents that are useful that we'll use to help us keep track of the cost and job order costing. So labor costs include time tickets and salary contracts for time tickets, which would be indirect labor. So we have a job cost sheet, which will include the direct labor. And then remember, any indirect labor is part of overhead. We'll look at overhead costs next. So what we want to do with overhead is we want to estimate an amount so that we don't have to wait for all of the overhead costs to come in order for us to assign a cost to a job that's completed. So what we want to do is estimate the total overhead costs for the next period. This estimated overhead cost, even if it's not exactly correct, we can use to estimate the job's total cost. And they're also useful to managers in decision making. At the end of the year, the company will adjust its estimated overhead to the actual amount incurred. And we'll look at all of the processes and the journal entries for this. So what we'll do is we'll take a predetermined overhead rate based on total estimated overhead cost divided by the estimated activity base. And then we'll apply overhead based on that activity base. To set a predetermined overhead rate, again, we will estimate the total overhead costs for the next period and divide it by what we have selected as our activity base, which would be either direct labor cost, direct labor hours, or machine hours. So here we have computed that the overhead should be applied based on 160% of the direct labor cost. So you can see that these jobs, the total direct labor cost comes to $4,200, and that means that the total overhead applied for all of the jobs together will be $6,720. And that is what our journal entry is for. So you can see we have debited work in process inventory and credited factory overhead. So you'll recall that overhead is part of the job cost, which includes direct materials, direct labor, and factory overhead. So direct materials and direct labor go into work in process. And this is how the overhead also goes into that account, the work in process inventory. We also have to keep track of the actual overhead. So the actual indirect materials, the actual direct labor, and then whatever the other overhead costs are. So here's a journal entry for the indirect materials used. So these would be the actual indirect materials. We will debit factory overhead for the actual amount. And then we're taking this out of our raw materials inventory. So we are reducing raw materials inventory, which is an asset, and we are increasing our factory overhead account. This is the entry for indirect labor. Again, we are debiting factory overhead for the actual indirect labor, and then we're crediting our factory wages payable for indirect labor. This shows the other overhead costs. So we have depreciation, we have rent on the factory, utilities in the factory, and then insurance on the factory. Those all added together equal the debit to increase factory overhead. This is the summary of the cost flows. So recall, if you look at the work in process inventory account, we have the direct materials, direct labor, and overhead. And then as it's finished, it comes out of the work in process and goes into the finished goods inventory account. When it's sold, it then goes as cost of goods sold on the income statement. Okay, this slide shows the summary of cost also. So looking at the factory overhead account, the ones on the debit side are the actual cost. This number on the credit side is the amount applied. And you can see that this is number 6, and you can see 6 down here, and the key is the overhead applied. So overhead applied goes into work in process inventory, includes direct materials, direct labor, factory overhead. So one thing we want to look at here, though, is that the factory overhead, the debits, which are the actual cost, versus the credit, which is the applied, there is a difference here. So there's a balance, meaning we have not applied enough. We have underapplied the factory overhead. The actual costs are $200 greater than the amount that we applied. This shows you all of the journal entries, and I recommend that you print this from the full PowerPoint slide in Blackboard And you can use this as an example for when you're working on your homework because it shows all of the journal entries. This is the schedule of cost of goods manufactured, which we also looked at in chapter 14. So finally, we want to look at adjustments for over or under applied factory overhead. So you'll recall that I mentioned the actual costs are on the debit side of the factory overhead account. The applied amounts go on the credit side. The difference means that we're going to be either underapplied or overapplied. And here are the journal entries at the bottom. If you are underapplied, so that means the actual is greater than the applied, you need to debit cost of goods sold and credit factory overhead because we're trying to get a zero balance in this account. If you're overapplied, meaning you've applied too much, you need to do the opposite. So here we will debit factory overhead and credit cost of goods sold. And again, you're looking at getting a zero balance in your factory overhead account. Here's an example of the journal entry for underapplied. Again, you will debit cost of goods sold and credit factory overhead. This completes the recorded lecture for chapter 15.